Buongiorno, Lugano. So today I'm going to talk about international trade and some historical perspective on historical trade and finance and payments involved in in international trade, I should say, and the prospects for using Bitcoin in international trade. So my partners in this project interviewed nearly a dozen companies that are using Bitcoin and or Tether for international business transactions, to pay for goods and services, to pay employees, or receiving payments from customers in Bitcoin or Tether. So we interviewed accountants and treasurers and executives, people in the company who would know how to deal with these things in terms of finance and accounting. So all of these businesses have developed treasury and accounting expertise that can be applied to using Bitcoin more broadly in international trade. These are very crypto-centric or crypto-adjacent right now, as you can imagine. It's the core of the people who are involved in using crypto. But they're developing the treasury and accounting expertise that can be now applied much more broadly in international trade. So that expertise is already under development. And so crypto conferences like this one, Bitcoin miners, and a lot of other Bitcoin-adjacent businesses involved, exchanges, NFTs, tourism, and so on. So if you want to do international trade in crypto, here are the three chief kinds of skills you want to master. First of all, you'll want to use trust minimized money, which I'll discuss the benefits of that, which are not obvious to the way today's finance and accounting people are trained. Because they lack historical perspective, which I will try to supply in this talk. And as of the first and former times, trust minimized money was gold and silver. And for the vast majority of the history of international trade, that's been true, that people they didn't trust a particular government or a particular merchant here or there. They trusted mainly the underlying gold and silver that they used. And today, Bitcoin is the most trust minimized money that you can also send. Unlike gold and silver, you can send anywhere in the globe almost instantly. And Tether, of course, is your next best bet if you're wedded to the idea of fiat stability, which I will also talk about. As usual in my talks, I'm going to start with the historical perspective. So the very beginnings of civilization involved trade, they involved accounting, and then only out of that came writing and arithmetic and mathematics and so forth. Before all that, there was trade and accounting. So 20th century archaeologists discovered that the first writing of numbers and words for things, it was invented for accounting. And one of the chief things that the accounting was applied to was international trade. Keeping records is especially important if you're operating in a lower trust activity across multiple legal jurisdictions, like international trade, then that makes record keeping especially important. And it makes trust minimizing the money you're using also especially important. So what they used back in ancient Sumeria, back at the time that accounting and writing and arithmetic were invented, or at least first written down, was mainly silver. And their laws said weigh and deliver. They physically weighed and delivered silver. This was before the invention of long before the invention of coinage. They were using gold and silver as a trust minimized global money. Now today, there is a wide variety of accounting software, but it's only starting to support crypto. There's definitely multi-currency accounting, but most of the multi-currency accounting features and the mainstream things are for various fiat currencies. That's their mindset is currencies must be run by a government or a central bank. So those are the ones that they support natively. However, there are a few that have gone beyond that and starting to support crypto. One of them is Cashew, a cloud-based accounting system for small business. They track and manage both fiat and crypto income and expenses. GNU Cash is a free and open source piece of software, again, useful for small business accounting and multi-currency accounting, including crypto. And there's tax accounting software for Bitcoin that's also very useful. And then a lot of the companies we interviewed were setting up their own customized spreadsheets as well. And so they're developing the expertise that hopefully will get more widely propagated in the form of new products into the wider ecosystem. And these solutions up here support Bitcoin and or Tether natively. Okay, so back to our historical perspective. A few millennia later, after the dawn of civilization, much of Eurasia was traversed by trading routes called the Silk Road. Broadly speaking, silver traveled east in trade for luxury goods, and the luxury goods traveled west. And the reason this is a stable state of affairs with China was probably the chief commercial civilization of that time, and they had tremendous demand for silver, but very little native supply of silver. So they were constantly craving silver imports from elsewhere. And in turn, they were great at producing luxury goods like silk and porcelain and so forth that people all over Eurasia wanted to buy. Okay, after Columbus and the other European voyages of discovery, the silver network became fully global. Here's a picture of the 17th century global silver network. Again, a global, seamless, trust-minimized form of money predominated international trade, as it always had in between the time of ancient Sumer and the time of Columbus and beyond. As silver spread around the world, it was transformed into a variety of different objects, culturally distinct ways of storing, displaying, and transferring the silver. So you could have silver mined in Mexico or in Central Europe. It could become a Spanish, as it made its way around the globe, it could become a Spanish silver bar, a dollar coin, a silver laren. These pin things in the Indian Ocean were used as money. If you wanted to see if the silver was genuine, you'd hold it over a fire and see what color it glowed. You wanted it to glow a nice white color. And a Chinese Sai-Si ingot. And I'm going to talk a lot more about these in my presentation tomorrow about the history of money. So so the non-sovereign money is the silver itself, the substance silver. That's the trust-minimized, globally seamless money, and but it could take different forms in different places, depending on the cultural and institutions. So the idea that countries would trust each other, or merchants would trust foreign governments with the value of money for international trade in historical terms is extremely unusual. It's highly anomalous. This is the norm right here, globally seamless money. And the idea that you as a merchant would trust some foreign government with the value of your accounting and use that as your standard of value in your accounting spreadsheet, that's an extremely historically anomalous state of affairs. But it's the culture we grew up in. It's what accountants are trained to believe. So precious metals and finance people most of the time. So precious metals have been around as a store of value and probably a means of exchange since about 4000 BC. So between about 4000 BC and the end of Bretton Woods in 1971, that was the predominant form of money. And currently we're in a radical experiment with pure fiat currency. And I'll talk more about that tomorrow. So today we live in this highly unusual situation of pure fiat currencies. And for today, we just need to note the slide here. This is the historical norm. And today's use of purely fiat currencies in international trade is extremely unusual. And by using trust-minimized money that goes almost instantly around the world, Bitcoin, in international trade, we're really just returning to the historically normal state of affairs. Even in purely domestic operations, there can be considerable legal uncertainty about the use of crypto. In the international sphere, of course, this regulatory uncertainty is amplified. And so much so that in international law, we might call regulatory uncertainty a tantamount to a euphemism for anarchy. And in fact, legal scholars have described international law as an anarchy. There's no Supreme Court of the world that's going to settle everything according to the same laws or customs. So when you engage in international trade, you're taking on a wide variety of unknown risks just by, even before you get to the currency, you're taking on a wide variety of unknown risks. And once you've solved the legal maze, you meet the Minotaur, and you can see all the skulls and things of businesses that have not survived the Minotaur. Okay, and so I have Silvergate and Signature Bank to remind us of the last bear market. During a bear market, we find out that regulators are hostile to crypto. During a bull market, politicians want to get donations, so they try to tamp down on the regulators as much as they can. And thankfully, we're in that state right now, but it's not a state that is a permanent state of affairs. It's kind of cyclical. Fortunately, this regulatory uncertainty, this anarchy really, is driving innovation. In fact, one of the original philosophies of the cypherpunks was called crypto anarchy, because the whole idea behind a trust minimized piece of money is you don't rely on the legal system. You rely on the mechanism itself to, in the case of Bitcoin, to settle the payments. So Bitcoin in the first place was motivated by this legal uncertainty. And you can think of Tether and smart contracts, DeFi, as similar. They've all been motivated by this regulatory uncertainty that you want to minimize your trust in foreign legal systems, and you want to minimize your trust in politically captured and bureaucratic things like banks, which I'll talk a little bit more about that. And so Bitcoin and smart contracts are made route around fiat and slow bureaucratic processes, which are particularly predominant in international setting. Stablecoins are made around the banking system, which is very highly resistant because the banking system is heavily centered around the pure fiat currency model. And so they're very hostile to crypto. And as I showed you with the examples of Silvergate and Signature Bank, the latest victims of that. Anyway, you can think of stablecoins like Tether is saying, we deal with the banks so you don't have to. But with Bitcoin, you don't have to deal with banks at all at any level if you stick with Bitcoin. So the anarchy is forcing crypto businesses to create self-regulating ecosystems that are more efficient and robust than the remote government regulation. Bitcoin Core and Lightning, I've basically already mentioned Bitcoin and stable coins and smart contracts and DeFi and Lightning as well. And so here's an example of the bureaucracy. This is the bureaucracy you have to go through if you want to transfer dividends across national borders. Things like, in America, we call them depository receipts. But there's this whole Byzantine set of bureaucracy you got to go through to transfer the dividends. And as a result, it's pretty expensive to buy foreign stocks. It's very far from a seamless operation. When you get underneath it, you end up paying a lot of fees. And taking on a lot of political risk as well. So a big subset of trust minimization, as it turns out in the real world, is bank minimization. Traditional finance resists crypto, so crypto has ratted around traditional finance. But it is a tall order to completely debank. No major company, as far as I know, has completely debanked. Some crypto businesses have partially debanked. They've reduced their exposure to fiat and to the banking system. And partly that's because the banking system forced them to do that. There's a kind of virtue in that, again, it's driven innovation to make yourself more independent of the banking system, which, as I will show shortly and tomorrow, actually presents some big risks that people don't really recognize very well. So you can slowly wean yourself from this etch-a-sketch bureaucracy of bank accounts by slowly reducing the exposure of yourself and your employees, your customers, and suppliers to bank accounts. So you have, as a business doing international trade, you have employees with their currency preferences, and customers, they have their currency preferences, and suppliers, their currency preferences. Their currency preferences these days are usually going to be their local fiat. That's not always the case. And of course, in the crypto community, crypto conferences, some of these other businesses that I mentioned, there are plenty of employees and suppliers and customers who are migrating to crypto. And it's an ongoing process. It doesn't happen overnight, so I call it the shrinkage of your dependence on the bank rather than just completely eliminating it. So each time you convince an employee or a customer or supplier to use Bitcoin or Tether, then you're engaging in bank minimization. And you're reducing your risks. So, question, as an accountant or finance person and treasurer of a company doing international trade, do you think politics, and especially foreign politics, in the long run is the most reliable way to account for your assets? If you've taken a look at, for example, I mean, I could point to lots of countries, but you just have to look at the United States today to see politics is not in the greatest shape. And if you're following the election, for example, and all the nastiness surrounding that. So do you really want your bottom line to be, and your treasury of your company to be so dependent on politics, on foreign politics in particular? Or would it be better to use a currency that is trust minimized, bankless, and politics minimized? Even if central banks are independent, they are still political actors. Most people in the US have strong opinions about, for example, what they do and do not favor for president. Do you think Fed governors are an exception to the rule? Of course not. Everybody in the United States has a strong opinion about the election, just about everybody. And that certainly does not exclude the Fed governors. And so the idea that the Fed governors are somehow independent and not involved in politics is pure fantasy. They certainly have their opinions, and anybody who has that kind of strong opinions, as people in the United States do right now, is going to act on them. And they're going to act on them in their professional capacity as well as in their personal and political capacity. So even if they're independent of, say, the executive branch or the congressional branch or judicial branch, they're not independent of their own strong political opinions. Okay, so the volatility, Bitcoin started out as extremely volatile, and it has a very strong reputation as being volatile, and that is probably the main reason that it has not been more widely adopted as a means of paying internationally and as a unit of account. Certainly as a unit of account, it's obviously at the current state more volatile than at least your top-notch fiats, at least in the short term. If you measure things with your normal statistics the way people do. However, the Bitcoin volatility is declining. It started out with extremely high returns and very high volatility, and it has declined. As the returns have declined, so has the volatility declined. And so at some point, it's going to converge on gold and silver and the better fiats in terms of its volatility, but also probably in terms of its returns as well. And at that point, it'll still make sense as a store of value, but it'll start making a lot more sense as a medium of exchange, and especially for international trade, where the use case, I think, for trust minimized money is particularly compelling. And so since Bitcoin is fundamentally a superior store of value, we can expect this, and I've gone over that many times in my presentations, so I won't reiterate that today, but it's a very superior store of value. We can expect this decline to continue, the volatility decline to continue. And fiat, they say is stable. They call fiat-based stablecoins stablecoins. And if you measure it with your common statistics over a short, period of history, that's true. But if you look at a longer period of history, this is what it looks like right here. It's stable until it isn't. And when it isn't, you can be in big, big trouble. So there is the Reichsmark. The Reichsmark actually went through 2 bouts of basically complete obliteration of its value. The Deutschmark, they got one for the Reichsmark and the Deutschmark. That's both the German currencies, but they went through this twice. The US dollar has been somewhat more gradual. The British pound had a huge, huge collapse. This is all the values of the fiat currencies in terms of gold. And those are the top-notch fiat currencies. Those are the ones of the most advanced developed countries and the most reliable central banks, supposedly. But even these are only stable until they're not. So because fiat is based on politics and your trust in politics, its failure is often associated with wars or other major political events, like the British pound's precipitous decline in the middle of the century was based on the decline and fall of the British Empire. So the short-term reliability of the major fiat currencies gives you an illusion of safety and an illusion of stability. And that illusion comes because of the limited statistics by which people measure volatility. If you used a more historical perspective, you'd realize that there are major fat tails, risks of black swan events that you can see if you look at the long-term history. So the standard financial models that people use to measure volatility are just completely, they're very incomplete measures of the risks you're taking by holding fiat on your balance sheet. So I'd say the number one rule you should take with multi-currency accounting, there's no such thing as a stable unit of value. You may have a standard or benchmark for convenience. Often your biggest supplier or the tax collector, whatever currency they're using, it usually makes sense to make your unit of account then, because that's the kind of money you have to gather to pay them. But it's still not stable. And you shouldn't do your accounting under the illusion that any of the numbers in your spreadsheet are some sort of stable value. It's just not the case. So in the short run, Bitcoin is more volatile than the dollar or the euro. So the businesses we've interviewed have developed some strategies for managing this volatility. For example, simply exchanging it, using an exchange, or for extra safety, a decentralized exchange. To convert your Bitcoin revenues to Tether, or if you really need to, bank account fiat. And you can also use DeFi. You can use Bitcoin options, for example, to hedge your volatility. And this is a completely common thing for larger businesses and international trade to hedge even the volatility of fiat currencies. They'll hedge using options or futures or other currency tools. And so these are available for Bitcoin as well. Hedge and Oppen are two examples of that. So in summary, it is already happening. Bitcoin international trade is already happening. It's not happening on a huge scale, but it is already happening. The expertise is already being developed on how to do it. And three of the keys are returning to trust, minimize, seamless global money, and realizing the hidden benefits of that don't show up in the standard limited statistics-based models of volatility. I should go back to that slide just to, nobody should be calling that stable. If they are calling it stable, they just haven't studied history. And so three of the keys are returning to that trust, minimize, seamless global money, and multi-currency accounting that includes Bitcoin, and smart contracts and DeFi for hedging risk. Thank you very much. Okay, so I'm happy to spend the balance of my time taking on-topic questions about this presentation. Yes?
Thank you. Do you see any future for silver as a minimum exchange in international settlement?
No, Bitcoin is just too, you can't send silver, within an hour to the other side of the world, or even very far, for several reasons, but no, it's obsolete. Yes.
I work at Rockstream, and I've seen a number of use cases for example, there are valuable assets in Latin American countries that are backing some loans with very strong legal security. And these assets used to be isolated from global liquidity because there was no connection. There were no laws mandating where to trade these things.
Mm-hmm.
And all of a sudden, through liquid, these assets are finding their way to global liquidity. And we see that very few banks are ready to trade with them, but instead there's appetite for them because they're actually very interesting. They have a very nice risk-reward profile. And also, circular economy is developing in a number of Latin countries as well that are interested in having access to savings, right? The savings in some of these assets. So I wanted to know if that's what you imply by this bank minimization.
Oh yeah, well, it depends on details. What are the underlying assets that are being traded here?
Promissory notes mainly, but
Okay.
also titles of credit. In Spanish we say títulos de crédito. They are typically promissory notes, letters of credit, bills of lading, these kind of assets, warehouse receipts as well. These kind of things that they have very strong legal security. For example, in Mexico, laws would go after you if you owe something that you don't pay. But they are very hard to trade, and also they've been paper-based mostly. And now in digital format, there's a way to link them cryptographically to a token, and then all of a sudden there's a way to use them as collateral to lend back to non-bank financial institutions that typically provide liquidity to individuals and SMEs in these countries.
Okay. Yeah. So that's a pretty good partial step. So. Presumably you're trust minimizing the actual trade and transfer of these things. The underlying, and you're routing around banks to do so, I presume, as well. But the underlying things are contracts that are enforced in a particular jurisdiction. So it's minimized, it's reduced. You've reduced your exposure, certainly to banks and to some extent to foreign governments. But you still have that underlying trust in a foreign government there. So it's not as good as Bitcoin, but it's probably a lot better than the current practice.
What would you say are the steps necessary for corporates to recognize the benefits and then settle their trade with Bitcoin?
Yeah, well, okay, the pessimistic side of me says that they're so ingrained, they've been so trained in a certain way with certain assumptions in this pure fiat goldfish bowl we all swim in, that it will really take one of these events. If you're in the steep decline, you will instantly recognize that actually Bitcoin's more stable than that if it's in the steep decline regime. Bitcoin's a great deal more stable than that. It's just, we usually live in the flat part, and so we don't see that, and people have been trained for the flat part. And so my pessimistic side says people aren't going to study history, and they'll just have to live through one of these fiat disasters to recognize it. Yeah.
Before you talked about trust minimized money, right? And you mentioned silver. Back then, were there also other things that they used instead of silver and gold, like copper, for example?
Yeah, you wouldn't use copper much for international trade just because it's so heavy and bulky for its value. You'd use that for local markets mostly. For global trade, gold and silver. Yeah, right behind you.
You said that for a certain point of time, stablecoins might still have a business case for trade, international trade. Which technical solution would you see superior to enable stablecoins on Bitcoin? Do you see it rather on the RGB side, Lightning side, or would you see it on layer 2 side chains? What would be the best concept to make stablecoins available on the Bitcoin layer? Because we don't want to leave it or do it on another blockchain.
Yeah, I don't know if that really matters because the biggest vulnerability of stablecoins is not the fact that they're done on a blockchain that's weaker than Bitcoin. It's the fact that they're dependent on fiat. They're fiat, in another form. So, I wouldn't want to use Bitcoin for that. If you can set up another blockchain that's almost as trust minimized as Bitcoin, that could be very helpful. Yeah.
Nick, it's good that people are starting to think about international trade here in the context of Bitcoin. but your first comment was that banks will not be needed at all. Now, the difference between a store of value and international trade is international trade is all built on credit in reality. And Bitcoin has a very, let's say, ambiguous relationship to credit. So I can't see any way of Bitcoin going into international trade without issuing what we call credit money to actually fuel the trade. And the relevant volatility is, so to say, not tens of years. We're talking about the trade cycle period, like 3 months,
Yeah.
2 months, 4 months. So that's the one which counts, and Fiat is still, unfortunately, superior there.
Yeah, well, yeah, most of the time it's superior, not all the time. And the times it's not, it can be catastrophic. No, it's not always. Look at the chart.
10 times of Fiat.
Look at the chart.
Yeah, you showed 10 years, Nick.
Right, if you're in that steep thing, it's vastly inferior to volatility. The Bitcoin, or the volatility jumps many orders of magnitude during those periods. You can't say all the time. Yeah.
You mentioned DeFi using Bitcoin, non-custodial DeFi for exchanging to fiat or whatever. Are you referring to particular platforms? Because I'm not aware of any real solid platforms which are non-custodial where you can do DeFi using Bitcoin, such as loans, collateralized loans with Bitcoin, etc. Apart from a couple of layer 2s which are not very liquid at the moment.
Yeah, that's not my understanding, but I'm not an expert on it, so you might be right. It's a discussion with him. Yeah, it's not. I'm not saying on Bitcoin. I'm saying using Bitcoin value, like these guys right here on Ethereum, for example.
They're on Ethereum.
Right, but they're
Using another layer of.
Well, it's another blockchain that's not quite as trust minimized, but it's a heck of a lot more trust minimized than the banking system or your alternative, traditional finance.
There's nothing much on actual Bitcoin chain, not even layer 2.
Right. Well, Bitcoin chain is specialized as the gold and the silver itself. It's not. I mean, some people might want it, but your best strategy, if you want something better in Ethereum, is to go build something better in Ethereum, not to try to make Bitcoin something different, in my opinion.
Or not even layer 2s? You're not in favor of that?
Well, the layer 2s aren't as trust minimized as layer 1s. So layer 2s are for, fast, small value things.
Not DeFi.
I mean, if it's low value DeFi, but not for the high value or ultimate global clearing. Okay, who else?
You think of any scenarios whereby Bitcoin can still fail?
Yeah, I didn't come prepared to talk about that. There's some extreme black swans, but they're very like quantum computing and an extremely highly unlikely coordinated global crackdown. But the global crackdown wouldn't kill Bitcoin; it would kill the peripheral things like the exchanges and so on. So it's just very improbable. I think they've had many years to kill it, and it's only grown. So, all right, yeah,
Can I ask you
sure.
your vision, how long it will take until Bitcoin will be adopted as a unit of account, like as the petrodollar was adopted in the 80s? Like the dollar became the petrodollar.
Yeah, it's hard to predict because it's based on these two graphs right here. This one, like when is the next fiat catastrophe going to happen? And this one, the volatility decline. So the longer it goes, if the fiats are just acting great and there's no fiat catastrophe, it's still the case that Bitcoin volatility is going to decline, but it might take 20 or 30 or 40 more years of decline to get there. If there is a big fiat problem, which historically is not improbable, then it could be quite a bit sooner.
But we had fiat catastrophes in Lebanon, in Greece, in Zimbabwe, and still nothing happening.
Right, but people aren't
I'm
people.
not flooding it, but
I
there's
know.
something missing.
No, people aren't conducting a lot of international trade in those currencies, as far as I know. If they were, they aren't now. So But they would have switched to dollar or euro or something like that. Yeah. Yeah.
Talking about the volatility, if it goes down and keeps it stable for Bitcoin,
Yeah.
what would you predict it for maybe 5 or 10 years as a value? I don't know.
Well, I mean, you could extrapolate this line. I haven't done that formally, but you could extrapolate this, and I'm pretty confident it will follow a similar thing.
Limit, like 100 or 100?
Oh, there's no limit. As it becomes more adopted as a unit of value, it grows less volatile. As it becomes, or as a store value becomes less volatile, then at some point it becomes so. Now it's already starting to be used, as I discussed with these crypto companies, it's starting to be used as a medium exchange. As that grows and it becomes less volatile still, and so the more it grows, the less volatile it becomes. And so it becomes at some point the most stable thing. It'll become more stable than fiat because it won't be subject to these kind of things. So, and there are at least a few people in the international fiat markets that are aware of this and hedge their risks and speculate and create some volatility as well. Fiat, if you look at the international fiat market, is not anywhere close to a zero volatility market, but Bitcoin will become lower volatility than the current fiats, I think. Yeah.
Can you elaborate a bit on the Bitcoin integration in Qclass or other accounting software?
No, I'm not an expert in those. I'd refer you to those people. You can. Yeah. So the experts on these are crypto conference people, the accountants and treasurers at crypto conferences, and Bitcoin miners and exchanges and people like that, and they have that expertise. My team has interviewed these people. They have a little bit of expertise, but they have the expertise, not me. So, yeah. That's still the best way to trust minimize the global money like Bitcoin. You might consider for other purposes maybe proof of stake like Ethereum is sufficient, but maybe it's not. Maybe you should have a proof of work based blockchain for smart contracts. Anyway.
So first I just say thank you for everything you've done for Bitcoin.
Yeah.
On behalf of everyone in this room, you've done so much, so thank you for that.
Yeah.
Your argument for Bitcoin being the hardest money is unequivocal. I completely agree with that. But like most of the other folks in this room, I'm curious if you could elaborate more on your thoughts on the contractual side, and specifically, a lot of global trade is done through supply chain finance. Chains of people who are expecting payment upon delivery for something that goes, into an end product, and the letters of credit that banks issue are standing behind the delivery of the capital in exchange for the product. So to minimize trust in that kind of network, you need sufficient inducement for distributed players to collateralize an untrusted producer of some sort of deliverable that they are contracted to deliver on the supply chain. And things happen, ships sink, storms happen, and there's recourse to that collateral. And so I thought your presentation was fantastic with relation to Bitcoin being the hardest money. I'm there, totally with it. But I'm curious if you have more thoughts on how to actually induce the right collateralization to actually have the supply chain participate in a decentralized way.
Yeah, so there will be some need for those kinds of credit institutions and insurance to start doing things in Bitcoin. And so that actually, I think that's a great entrepreneurial opportunity, is for people to start to develop that kind of thing, extend it to crypto, extend it to Bitcoin, Tether. For Tether would be somewhat straightforward to do. If you're an insurance company making global payments, or if you're banks resist it, but maybe you could set up a new kind of institution that does that function, but doesn't have to go through all the bureaucracy banks have to go through. That might be, maybe legally that wouldn't work, or maybe it'd be a great entrepreneurial opportunity. I don't know.
I agree.
Yeah.
I'd love to work with it.
Yeah, I'm too old for it. Yeah.
What is your view on smart contracts except of Bitcoin? For example, houses or objects? Because why should I be necessary to use a blockchain when I can also use a data
Well, a database is Etch-a-Sketch. People can just change it. You can't change a blockchain. If you're doing global trade, you don't want to have something where your counterparty can just go change the record and you're up. Or a foreign government or a foreign bank can just go change the records or have some political reason why you don't get your money.
But when I buy a house, someone has to write it on the blockchain. The blockchain does not know that the house may have burned or that there was an earthquake. Then it's also centralized, like for example, a database on Excel.
Oh, sure. Yeah, I'm not saying all these assets, especially something as personal house, are going to be completely blockchainized. So I'm more talking about money and the payments people use, the credit people use in international trade. Yeah.
Are there any parallels that can be drawn between gold and silver mining and international distribution of Bitcoin mining?
Parallels between mining. I mean, that's a well-worn subject. It's not really the topic of my talk. Lots of people have talked about it. Although I guess I should know, since I think I'm the one who first used the mining metaphor in the first place, but that was a long time ago. Yeah.
You mentioned that there's no major corporations that are putting Bitcoin in international trade. But do you have any statistics, or how would you go about getting statistics of who is using Bitcoin in international trade? How would you know that it's actually starting to work?
Yeah, that would be hard. I know because I've gone, and my team has gone and interviewed these companies. And so, I kind of get a feel for how much Bitcoin they're using, how much Tether they're using, how they deal with it on their spreadsheets and that sort of thing. But yeah, I mean, it's small. It's not at the scale of, the big cargo container shipping companies and all that stuff. But it's growing. I mean, every time they convince a new supplier or customer, employee to take a payment in Bitcoin or Tether, then that network grows. So. Anything else? Way in the back.
Yeah, I was just wondering, are you aware of any nation states using Bitcoin in international trade and the kind of use case that would be?
Yeah, I am not. Samson Mao might be a good guy to ask that. He's really involved in the nation state thing. I have not heard of it myself. Is there another one right there? Oh, you right there?
Oh.
Yeah, you.
Yeah, myself. Okay, thanks. Along the same lines, you mentioned that, of course, it's dependent on government, what I mentioned before about these assets in Latin America.
Yeah.
But I'm wondering if, I remember that you linked in one of your articles to a paper from Miller and Stigler, where they described how a blockchain could, or a computer network as they described it, it could extend the reach of an existing reputed institution. So I'm wondering if, although eventually the goal would be to have this on a trust minimized way, you envision as a way to, let's say, accelerate it, to extend the reach of those existing institutions, laws and strong legal security for those assets, and eventually perhaps switching to a more stable and trust minimized kind of collateral, basically as a security backing that loan. Mm-hmm. How would you envision that trust minimization process? That's basically my question.
Well, I mean, that's a very broad question. I'm not sure it's sufficiently confined to our topic here. I guess for our topic here, the kinds of assets that we'd be interested in are things that back, like marine insurance, for example, what insurance companies invest in. But I guess addressing your topic and your question, there are ways to make, so blockchains are post-unforgeable. The difference between them and a traditional database is once you put it on there, people can't change it. But there is still a problem of getting reliable information on there in the first place. And so because at least the assets she was talking about, and I think some that you're talking about are things like real estate that are very local, you still have that local dependency. And so you get some win from that that trust minimization is not a big a win as you get for money itself or some other areas of finance. Okay, question.
So, do you think is there any possibility that the American dollar, will be backed by Bitcoin as a store of value?
Oh, yeah, it's possible. I don't know if that's the most probable currency I'd point to in the near future. But, yeah, I mean, it would be wise for fiat currencies to try to base themselves on something more stable, in a real sense stable, historically stable, than politics. Politics is kind of inherently unstable, but we're starting to see that becoming more visible. And so, yes, I think it would be wise for them to do that, to evolve in that direction anyway.
When understood as a accounting innovation, then to what extent would Bitcoin replace an outdated way of doing accounting, which is double entry bookkeeping, which is still used today? And I see great inefficiencies in doing that. To what extent would that help in transitioning towards international trade, doing with Bitcoin? Maybe also on the more optimistic side, as you alluded to earlier, with the pessimistic side.
Yeah, I mean, the main challenge for Bitcoin is just the challenge of any multi-currency accounting, just having the more complicated thing of having several currencies in your spreadsheet. That seems to me, I'm no expert, but it seems to me that's orthogonal to the double entry versus other methods of accounting question. So it may or may not help, but it might not.
To what extent, maybe I phrased the question difficult, but to what extent do you think that Bitcoin will replace double entry bookkeeping to allow for international trade?
Oh, no, it's not a method. It doesn't replace double entry bookkeeping. You still need to keep your books when you're doing Bitcoin. Bitcoin doesn't magically make accounting go away, or needing to, make sure your employees are not spending your money unwisely, or all the things you use accounting for, you still need to use accounting for. And in fact, to some extent, you have to go back to a world of bearer instruments and cash. The Bitcoin itself you need to have more control over. If you've got a company full of employees, you don't want just them all have access to your Bitcoin treasury willy-nilly. So there are definitely control issues that are unique to Bitcoin. They're kind of in a layer somewhat different, separate from the accounting now. Okay, over there.
I'm assuming that good international trade with Bitcoin relies on good international mining of Bitcoin.
Mm-hmm.
And whilst gold and silver has to be international mining-wise, Bitcoin mining in theory could become more and more centralized. So how can massive worldwide players believe that Bitcoin mining is going to stay centralized over the world?
Oh, well, they could set up their own mines so that they have their own cut in the thing. If I was a major player in international trade, if I wanted to get into it in a big way in the billions of dollars, and I had those doubts, then I would set up mines of my own, and that would help to centralize it right there. I don't know. Bitcoin mining is profitable. It would be a good side business for these guys to be in. Okay, thank you very much.